Good morning, good afternoon, good evening to EMFP's members and friends around the world. My name is Sam Mendelsohn. I'm Financial Inclusion Specialist at the European Microfinance Platform. I'm very pleased today to introduce someone who probably needs no introduction to most of you, and that's Roshana Zafar, founder and MD of Cash Foundation in Pakistan. Cash is a non-banking microfinance company regulated by the Securities and Exchange Commission of Pakistan, and it was set up in 1996 by Roshana as the first specialized microfinance institution in the country. Cash also won the EMFP organized European Microfinance Award in 2016 on microfinance and access to education for its low-cost private schools initiative. We at EMFP wanted to reach out to Cash and Roshana because of the organization's unique experience facing challenges in the past and overcoming them, something which gives it and her valuable insights. This video is a bit different to how EMFP in the past has profiled our friends and different actors. And we thought that rather than as a written Q&A or a survey or a briefing note, we'd record this video interview, which we hope will be the start of a series of interviews and case studies with institutions that have weathered major crises in the past and come through well. What did they do? What lessons did they take from their response? To what extent are those lessons applicable for what is being faced now? So we'll dive right in. Hi, Roshana, can you hear me? It's good to see you.
Good to see you too, Sam. Great to be here.
How's it going?
Well, it's been interesting. As I was thinking about this and reflecting on it, there are similarities to the past also, but this one has hit us, we've been blindsided to an extent that we weren't prepared for it. So we've had to do a lot of things on the go, but it's been a learning experience. I think I always say, don't let a crisis go to waste. That's right. Really my theme. Whenever things like this happen, you can learn from it, you can innovate, you can do new things. And look at your own business with a different perspective.
So let's start in the present and then we'll work backwards. First, can you update us on what the current situation is in Pakistan and the regions where you work? Lockdown, as I understand it, has for the most part ended now, but what are you seeing in the economic trends and how is it affecting you and your clients?
Certainly. So basically the lockdown started on the 23rd of March. Pakistan was a late, arrival into this. So we had our first case on the 26th of February. So they locked down within 3.5 weeks of the first case being reported. And we've had about 8 weeks of full lockdown. So what we did as soon as the lockdown happened was to come up with mechanisms for contacting our clients. That was critical. And we needed to understand what was going on with them. So we did a survey in March and then one in April to see how COVID was affecting and how the lockdown was affecting businesses. And what we heard from clients invariably was that almost 70% of them had, their revenues were reduced or their business income was substantially cut down because of two reasons. One, because of demand, and the other because they were unable to really go out there and, if it was a street hawker, for example, they couldn't go out there and sell their goods. And so what we saw were two things. One was happening was the businesses themselves and their revenues, and the other was the inability of the households to manage cash in terms of meeting their daily needs. So when they needed food, they needed money for purchasing food items, they didn't have the cash and the liquidity. So those were the two stresses that we saw. However, on the other hand, when we talked to them about their willingness to pay, over a majority of our clients said, well, when the lockdown is over, we will start looking at, we will start repaying, we will see how we can repay, but can you think about rescheduling? So those were the kind of messages we were getting. And when we did the same survey in April, we heard pretty much the same sort of story or narrative. At the same time, we also did an assessment of trades. So what we saw was that there were two kinds of businesses that were emerging. Ones that were insolvent, that needed money post the lockdown, and the others that were illiquid. What that means is that they were still having business revenues come in. These were essential services like grocery stores, like anybody buying or selling food items or running small, stalls, fruit and vegetable stalls in the community. So those are the business that were not affected and which could still continue. So that's what we saw in terms of COVID and how it affected our clients. And then as an entity, of course, we had to look at our own recovery. That became our biggest challenge and still continues to be. So we have to look at our cash flows again, and we had to start seeing how do we recover this money? Do we reschedule? Do we restructure? What kind of products do we offer our clients to help them overcome the hurdles that they were facing?
Have you been able to continue new lending over the past weeks, or has there been a hold on that?
So the first challenge was that we couldn't open our offices. So there was no way of reaching out to the client. So disbursement was a no-go. We couldn't really disperse to people. And also because their businesses were shutting down due to the lockdown. So it didn't make prudent sense to really be dispersing at that time. But now that the lockdown is over and our offices are open and we are with COVID protocols kept in place in terms of hygiene and in terms of social distancing, our staff is now accessing clients in the communities and going out there either telephonically or physically and sitting down with the clients to understand their business and enterprise needs, their ability to repay, and their rescheduling options that they would like, whether it's a 90-day window deferment they want, a 60-day, or whether they want a longer term track which can go up to 12 months. So we are going client by client, and that is really one of the lessons that one derives from the past also. Client relationships in this case become very important. The messaging that you do to the staff becomes very important. So when we had to shut down our offices, we immediately had to go remote. So remote conferencing, remote connections, setting up WhatsApp groups, immediately. Technology has helped. If we didn't have this technology, we would have been in bigger trouble than we are today. The technology helped us to contact the clients because 95% of our clients had cell phones. And we had that information, so we could contact them telephonically. Staff had smartphones, so we could put them on WhatsApp groups, we could put them on Zoom meetings. And what we did was we cascaded the whole approach. So we didn't say you had to meet 3,600 staff altogether. You cut them down into manageable little groups. So you had branch managers meeting their area offices, managers, then the regions meeting their branch managers over Zoom. And then of course the senior management meeting every day to make sure that the communication was cascaded down fairly quickly. So the turnaround time on messaging was very fast. And I think that helps us from the top to the frontline offices to the clients. So when we had to send the rescheduling message, we were the first entity that realized that clients are not going to be able to pay, because when we did the survey, we realized they are cash strapped and their business revenues are down. So we said, let's do an en masse rescheduling for 1 month, which was April, and then go back and do a customized restructuring or rescheduling as required, and then touch each client and their enterprise. So I think that strategy actually helped us, because then there wasn't pressure on the staff, because staff was feeling also very stressed. How are they going to recover them?
I was going to say, I mean, it's stressful for everyone in the world, but to the stress of staff dealing with vulnerable segments and for people whose incomes, whose livelihoods are so precarious, it must be just hard to imagine the kind of pressure they're under. I mean, what can you even do as an institution to mitigate that?
I think there were several things, Sam, that we did. For example, all the top management were given names of staff to call directly. So I called frontline officers, like 100 of them myself directly, to speak to them, to motivate them, to understand what they were feeling, so that any policies that we brought in, I had the empathy to know that. We also spoke directly to clients, and we understood that they are highly vulnerable to the lockdown. This has totally destroyed their livelihoods. And as an entity, we have to be empathetic. And we are a transformational institution. We work with women, and what people are saying right now is that post-COVID, it's going to be a she session. It's really going to affect women entrepreneurs more. It's really going to affect women jobs, female-led jobs more across the board. This is data that's coming out across the world. So when we look at the notion of she session, it's hard to say, it's like a tongue twister. We really need to be more empathetic to what kind of post-COVID or post-lockdown products we are going to bring in for female entrepreneurs. So this is going to have a feminine face. So empathy, compassion, the staying power on the other side, having lenders and investors who also understand this. Because our cash flows as an entity are being affected. So we've been lucky that way as a country, that our regulator has been proactive. And we were given, they immediately came in and gave us special solutions on provisioning. If we, for example, if we restructure a loan, or if we relook at the terms of a loan, those will not have to be provisioned against, which normally it is. So they've changed the policy for provisioning, which will then help us to reschedule and restructure loans and not affect our equity or our business bottom line. We've also had our lenders come in and give us the option to reschedule our loans. So all of this has to come together. And then we're also looking at, so there have to be several phases of managing this. Lobbying is one, we've been doing that. And again, Zoom, again, technology has helped us, because sitting in our own homes, we've been able to connect with the regulator and make them understand the importance of not just microfinance, but its impact and its direct link to poverty alleviation. And in a country where 2 out of 5 people are at or below the poverty line, it becomes very, very important that we raise this issue with powers that be and help them understand that if the microfinance industry fails, poverty alleviation also goes out of the door. So I think that is another piece that has worked for us. And we are still continuing. This is work in progress, as I was saying. So this is, lobbying also becomes, in addition to connecting with your clients, ensuring you motivate your teams and listening to them, lobbying and the larger externality that goes around microfinance is also important.
Let's go back 10 or 12 years now, if we can. And there were, I think it's fair to say, twin crises that had to fail over that couple of year period. And correct or add to this as needs be. But in 2008, there was a repayment liquidity crunch that cash faced because of several factors. I think unfounded rumors about a death and rumors about cash's imminent failure. And these rumors were exploited by other actors too. And then 2 years later, after you got through that, there were the floods that affected the livelihood of so many cash clients. Firstly, is that broadly accurate? And can you tell us more about what happened and what it was like to go through one, make your way through, and then be faced with another?
So 2008 was a crisis that was politically engineered in a lot of ways, because we went back to democracy for the first time, and there was a lot of politicking, a lot of activism going around. That was one aspect of it. The second aspect of it was that we had grown very fast as a sector. So a lot of loan practices had been weakened, and there was a lot of poaching of staff across the sector. There was a lot of over-indebtedness that had emerged. There was a concentration of the industry in few markets rather than dispersion across several markets. That was another problem. The third issue was that we were not mapping sector level data. So we didn't have a credit information bureau, for example. So we never knew the extent of over-indebtedness or the extent of people who had parallel loans out there. So there were several aspects that came together. And then add to that the fact that 2008, there was an international financial crisis, and Pakistan had one of the highest food inflations in the region. So food inflation had really shot up from August 2008 to October 2008. Against that bandwidth, in October, we started seeing in 2008 the issues emerging. And the background to this was all these other issues that I talked about. And then the fact that politicians came in and announced loan write-offs, which then spun out of control and went across the sector and started with Kashf, but affected the entire sector. Now, that particular crisis was a credit discipline failure crisis. The whole entire industry faced a discipline issue where credit behavior changed radically. And that whole notion of when, the microfinance is built on incentive and behavior. Obviously, behavior is driven by incentives. We know the psychology behind that. So when credit behavior changes due to a complete collapse of incentives, that's when things go really wrong. And that's when you then have to, because it's about building a relationship, it's about trust. So that was a harder crisis. and to come out of. When 2010 happened, that was not a credit behavior crisis, it was a general risk issue. So in 2008, we were grappling with a much deeper quagmire when it came to the things that had to be corrected. For example, what we discovered was group methodology in such an environment will not work. You have to come up with a new methodology for assessing the credit behavior of a client. The group, you can't rely on the group. And essentially, we were also seeing group fatigue. And this happened in India. We saw that. It happened in Morocco. It happened in Nicaragua. So you had several, this was happening across the world. So you had a heating up of the sector in terms of growth. And then you had a group fatigue going on. So the methodology itself came under test. And that's what happened. And we really what we had to do at that time was to change our entire lending methodology 180 degrees from group to individual enterprise lending based approaches, where the credit appraisal tool was very different. It meant retraining the staff. It meant coming up with new products. It meant developing new thresholds for risk. So that was a much bigger crisis. It was in terms of an entire cultural refix of the organization. We didn't change the segment, by the way. We continued to service low-income women, and that was our ethos and continues to be our ethos. So from 2008, we were the first ones to actually revamp the program and come up with new products and approaches and develop a new methodology for poverty lending to micro women entrepreneurs, which was essentially individual lending. So essentially, when you talk about women and when you talk about microfinance, you generally talk about solidarity lending. But we now no longer do that. And of course, technology helped us, and we use many other drivers to get us to make that efficient. Our first challenge was, how do you get, in a group lending methodology, there's aggregation. So 25 women are equal to one loan. Here, one loan is equivalent to one loan, so the delivery costs go up. So that was our big challenge at that time.
Well, the trust dynamic is different, isn't it? Because in a group, primarily the trust needs to be within the group. And when you move to individual, it has to be trust between individual and institution. The trust that if I repay on time, I can be offered more credit, and that trust is reciprocal. How do you bring, I mean, you talked about incentives, but how do you focus on that issue of trust if there is a contagion of mistrust across the sector, across the industry?
So I think, Sam, the challenge at that time when credit behavior breaks down and the discipline concept breaks down, when trust and relationships are tested, then what we discovered was an individual relationship was much more effective than going through a group. Because through a group, you don't really know who is a net borrower, who's a net, what was happening in a group is with the concept of pipelining. So if there were 25 people in the group, it wasn't necessary that the loans were used by all the 25. What had happened over time was maybe 10 people were using the loan and 15 people were just part of the group because they had been cajoled or coerced by the others to stay. That's how group lending works. It's graduated. So everybody stays in the group because it's of value to the others. So a lot of malpractices were there within the group, which were non-transparent, and we hadn't been able to delve into them. But when you go individually and you're looking at the enterprise and you're looking at the entrepreneur and you're helping them build their own capacity to borrow and to be productive, then it's very transparent. So what we did was we looked at the credit appraisal, but at the same time, we looked at some legal alternatives. So for example, we introduced the post-dated check. We introduced a bank account. We also started documenting the client. Prior to this, we were very informal. We didn't require identity documents, for example, national identity, formal documents. Post 2008, we said, no, everybody has to be documented. So we started, and we had to work with clients who didn't even have national identity cards, which is like a social security card that you have elsewhere. So we had to help them go to the local offices of the authority, get their identification cards done, be registered, be an entity, and then borrow from us. We also have them open bank accounts. So we formalize the system like you would do for any small enterprise. So in a way, in the long run, that actually helped because they began to be counted. The value of the national identity card was not just because they could open bank accounts or get a loan from Kashf, but they could also vote. So their voting power in the election time also started being generated. And now there are 7 million low-income families, which is 30 million people with national identity cards, which is a huge contribution, because then if you vote, you're heard, and you may impact policies in the long run.
I'd like to come back on you talked just previously about the regulatory response and funders and communicating with investors. We're only 3 months into this crisis, and you said that both the regulator and investors have provided considerable flexibility, so you can sort of transport that flexibility to your clients. How does this compare to a decade ago?
Right. So I think a lot has changed in the infrastructure of the industry. So let's talk about that first, and then I'll also talk about the perception, because perception and optics are very important when it comes to microfinance. So if we look at the infrastructure, we now have 2 regulations that actually provide oversight to the sector. One is the Microfinance Banking Laws Ordinance, and the other is the Non-Banking Microfinance Company Act. So we have 2 laws under which we can register. So the first thing is now this is formalized. Prior to in 2008, we had not-for-profits under different legal mandates. But now, if you're a microfinance entity, you have to register under these 2 laws, and there's oversight. Second, we have as I mentioned to you, the Credit Information Bureau. Not only 1, but 3 of them. So we have sliced and diced data now available. We can look at the sector. We know exactly what the level of over-indebtedness is when it comes to the client. And the client also knows that if they have a bad credit history, nobody's going to lend to them, which we didn't have in the past. So these are 2 very, very important things that have changed. Then the growth in the sector. Now we have over 50 good, viable microfinance entities, whether microfinance banks or non-banking microfinance companies, that have over 7 million clients. So again, there is substantiation that microfinance works. There is aggregation, there's numbers. People take us seriously. So in 2008, we were around 2 million. So the numbers were not there to ratchet up, and the business case had not been proven. So now, it's a serious player, it's a serious sector, and poverty alleviation, we have demonstrated through lots of research and outcomes and impact assessments that this is making a difference. So I think that whole optics have also changed. Then, of course, there's a National Financial Inclusion Strategy, NFIS, of the government, which includes microfinance as a key piece, both for poverty alleviation and for access to finance. So once you have policy, once you have policymakers involved in this, there is a seriousness to what needs to be done with the sector. We have both regulators that are lending voice to the sector, which didn't used to be there before. So there's a big difference between where the industry is positioned today than where it was in 2008 in terms of its relevance to poverty, to impact, to financial inclusion. So I think that whole dynamic has changed. Now let's come to the operators. How is this different? As I said, this is not a credit behavior issue. What we were recently looking at our credit scorecards. We run a credit scorecard at Kashf for every client, and that, like I said, technology has been a key driver when we switch from group to individual lending. And we were wondering whether our algorithms would work now, because there has been a hiatus of about 8 weeks in repayment. So when we ran those algorithms and we were sitting with our the experts who do this financial data analysis, there was no difference. So it again harkens back to what I was saying in the beginning. This crisis is very different. This is a crisis that we can learn from, we can manage, we can leverage on technology, we can come up with new products, we can understand the needs of the clients, we can come up with ways to manage it. But it's not about the willingness of the client to repay. It's definitely about the ability. So the whole notion is a little different. Of course, this also means there will be market corrections because the organizations that manage this period better, that are closer to their client, that are more client-centric, will actually be the winners at the end of the day. The ones that are unable to manage their costs and are unable to manage that relationship and the risks that emerge from it, will not survive. So this is going to be a market adjustment as well, post-COVID. We will not see too much growth. The question you asked was, were you going to be offering new, more loans? Our strategy right now, and I'm sure you will hear that echoing across the industry elsewhere also, we are going for repeat clients right now. We are not looking at new clients because new clients are a different kind of risk. Of course, that doesn't mean that demand, in Pakistan, they're saying 18 million people will be out of jobs. And these 18 million are essentially self-employed people or home-based workers, essentially the segment that we serve. So there is going to be demand. They are going to be looking for capital injections and loans, and of course, other services as well. But currently our stance is we must serve our existing client base and then out of that build a more, stronger, more robust portfolio. And at the same time, over time, not immediately, start servicing new clients. So this is really the approach we are following right now.
I've got to say, you sound quite positive. We at EMFP, we're talking to everyone all the time, and so many people talk about the devastating consequences of COVID across the industry, across the sector, on all types of stakeholders, as if it's axiomatic. But you seem to feel some confidence or even optimism, at least from Cash's point of view. Is that fair, or is it specific to the organization because you do this well and you've got the experience you're talking about, rather than for the sector as a whole?
So Sam, if I was to mention to you the state of affairs in May, as of 15th May, we had not projected any recovery coming in this month. We were pretty clear that having spoken to clients and looked at their, their revenues and their profits and their sort of economic concerns, we felt that nobody would pay us this month. To give you an example, 41% of my clients have paid me unsolicited. So what this is saying is that people want to pay us back because they have a good relationship, they see a good future. Their ability may be affected in the next 90 days or 4 months, but since Pakistan has opened the lockdown, businesses will start emerging. People are resilient, they're tenacious. And they will come back to life. And having been through an existential crisis, it's like the proverbial phoenix rising from the ashes. I always quote that. Having gone through a crisis where we thought we wouldn't be able to, be there, we wouldn't survive the next day, we actually did. And I have yes, I do have this optimism and belief in the human spirit that people want to come out of this and come out of this successfully. So the individual enterprises that we support, some will fail, many will fail, but many more will come out. And the ones that fail, I was just quoting Nelson Mandela. He was saying the success of life is not always being successful and coming out well. The success of life is when you fall down, how quickly do you get up? And that's really the determinant that I see. When I see enterprises, when I see micro female running businesses, they fall down all the time because somebody falls sick in the family, something happens. There are all kinds of crises that they face, but ultimately they always get up and start again. So I think that's the resilience that we are betting on, and and on the other side, we have to innovate. The onus lies on us as microfinance operators as well. What can we do more in this time? That is really the crux of the matter, and we need to come up to speed on that. So yes, I remain optimistic, and yes, it is going to be a challenge. And yes, we will get out of
it. Roshana, I'd like to thank you for taking the time to talk to us today, and from all of us at EMFP and the wider European inclusive finance community, to wish you and your staff and your clients very best. For those of you who want to hear more about the specifics of what Cash Foundation is doing to respond, you can also read the blog, Perspectives from the Front Line, How Cash Foundation in Pakistan is Dealing with the COVID-19 Crisis. That's on the EMFP blog site. Thanks again, Roshana. And in the words of Vera Lynn, we'll meet again. So take care.
Yeah, inshallah. Thank you so much, Sam. Lovely to
Thank you. Bye. Bye.
Bye-bye.